So, the big question on a lot of people's minds, I think, is it over?
Yeah.
For Bitcoin, I mean. Should we just, pack it in?
It's definitely a feeling that crops up, especially with market swings.
Exactly. The ups and downs, they can feel pretty intense, right?
Yeah.
Especially if you're maybe newer to this whole space. It's a bit of a roller coaster.
For sure.
So today, we wanted to do a deep dive into exactly that uncertainty.
Yeah. Cut through some of the noise.
Right. We've got some sources looking at recent market stuff, some fundamental economics, even what some, big name experts are saying now.
And how their views might be shifting.
Shifting, exactly. The goal here is really to equip you, the listener, with a clearer picture, help you see beyond just the headlines.
Make sense of the bigger movements.
Mm-hmm.
And, just as a starting point, that initial gut check from our sources,
Hmm.
it's pretty clear. It's
Yeah.
saying, no, it's not over. Not by a long shot, apparently.
Okay. Well, that's a strong start.
It is. And it's not just wishful thinking. There's data and context behind it.
Good. So let's unpack that because you hear about these dips, right? Bitcoin's down 9% from the all-time high.
Right.
And maybe that sounds like a lot. Doesn't exactly scream chill, does it?
No, not on the surface.
Mhm.
But the sources really emphasize looking at it differently, using a log chart perspective.
Okay, the log chart. Can you quickly explain what that is and why it paints such a different picture? Because linear charts can look pretty scary.
They absolutely can. So a log chart, it basically adjusts the scale. Instead of showing equal spacing for every dollar increase, it shows equal spacing for percentage increases. Like
Mhm.
going from $10 to $20 is the same distance on the chart as going from $100 to $200.
Ah, okay. Because it's a 100% jump in both cases.
Exactly. So it helps visualize long-term exponential growth much better,
Hmm.
kind of smooths out the curve and puts these recent dips into, well, perspective.
Right. So that 9% dip on a log chart, it's less dramatic.
Much less. One source described it as not even a full correction in the historical context of Bitcoin.
Not even a full correction. Wow.
Yeah, when you look at it that way, it sort of takes the panic down a notch.
Definitely. So how chill are we talking then, really? If 9% isn't much, where does that put us historically?
Well, the analysis suggests Bitcoin could theoretically drop back even to around $100,000 and still be considered on trend within its long-term logarithmic growth channel.
$100,000
Yeah.
and still on trend.
Yeah, which is why the sources are calling this period chill, super chill, especially when you compare it to past mid-bull runs.
Okay, like what happened before?
Oh, I mean, think back. Prices would get chopped in half regularly. You'd see these 50%, even 80% drawdowns.
Oof. Right. Okay, so 9% feels a bit different in that context.
Massively different. It's relatively calm seas compared to those storms.
That perspective shift is helpful, but it's not just about the dollar price, is it? The sources also talk about Bitcoin's strength relative to other things, like gold.
Yes, that's another really important angle. Some very bullish signs when you measure Bitcoin not in dollars, but in, say, gold. Specifically, it's broken above a key level.
Yeah.
1 kilogram of gold per Bitcoin.
1 kilogram of gold. And why is that significant? Was that like a ceiling?
Exactly. Think of it as a resistance level. For about 4 years, Bitcoin, priced in gold, kept bumping up against that 1 kilo mark and couldn't really stay above it.
Right.
Breaking through that and holding
I think
suggests a pretty fundamental shift. It's a technical breakout against, the ultimate traditional safe haven asset.
a 4-year resistance broken, that sounds like a big deal. And not just gold either, commodities too.
Same story there. Our sources point out it also broke above a similar long-term holding pattern, maybe 4.5 years, when measured against a basket of commodities.
Ah,
So even if the dollar price has let's say, a down year or trades sideways for a bit,
yeah.
its value relative to these fundamental assets is showing some serious underlying strength. It suggests something more profound is happening under the surface.
Okay, so we've got less scary drops, at least historically speaking, and this underlying strength against gold and commodities. It really does feel like the sources say a little bit different this cycle.
It does.
More of a slower grind up, maybe, and the drops are not nearly as bad.
That seems to be the observation. And a big reason for that, according to the analysis, institutions.
Ah, the institutions, how are they changing things?
Well, think about it. You have these large players now, maybe managing money for clients,
Mhm.
and their job, or at least part of their strategy, is often to buy the dip.
Right, they have mandates or just see it as an opportunity.
Exactly. So when the price drops, you have this more consistent professional buying pressure coming in that perhaps wasn't there as strongly in previous cycles, which were more retail-driven.
So they're kind of ironing out the volatility, as one source put it.
That's a good way to phrase it. Yeah, it
Yeah.
dampens those extreme swings we saw before.
Yeah.
Makes the whole market feel a bit more mature, perhaps.
Interesting. But what's also interesting is that despite this institutional presence,
Yeah.
the sources also say retail is not really in this market yet. Like everyday people aren't piling in.
Right. There are anecdotes about, people asking about Bitcoin more, your neighbor, your cousin.
Mm-hmm.
But it's described as more curiosity, not that FOMO type of reaching out, not the frantic, I gotta get in feeling from past peaks.
So what does that tell us? If institutions are buying dips, but retail isn't FOMOing.
It paints a complex picture. But one really fascinating take from the sources touches on this kind of nihilistic mindset.
Nihilistic, how so?
Well, the idea is that many people, particularly maybe younger generations, feel so pessimistic about their financial prospects in the traditional, the fiat world.
Right. Worried about housing, retirement,
Yeah,
the usual anxieties.
exactly. They feel like the standard path is broken, and because of that, they almost feel like they need a lottery ticket, some massive gamble to get ahead.
Okay.
So counterintuitively, they look at Bitcoin, even with its potential upside, and perceive it as not risky enough.
Wow, not risky enough. That's
Yeah.
quite something.
Isn't it? It suggests a real disconnect. They're looking for something extreme because the normal system feels so hopeless.
That's actually kind of sad. It highlights a misunderstanding of what Bitcoin might actually offer, doesn't it?
Completely. Because the sources frame Bitcoin's core promise as almost the opposite of a wild gamble. It's presented as a return to something simple,
Which is?
just being able to save your paycheck, to spend less than you earn and put the difference into money that nobody can print more of, eroding its value.
So a return to basic financial prudence, but with a sounder form of money.
Precisely. Not necessarily a moonshot, but a way to preserve the value of your work and savings over time. Which is a pretty radical idea in today's world, apparently.
Yeah, it seems like it. This idea of sound money, and maybe our current money not being so sound, leads perfectly into the next big theme from our sources.
The measurement problem.
Exactly, this fundamental disconnect. Because logically, things should get cheaper over time, right?
That's the core principle. Human ingenuity, technology, efficiency. We get better at making stuff. Constantly.
So if it's easier to make a TV today than last year,
It should be cheaper. If it takes less effort, less resources to build a house now than 50 years ago.
it should cost less, measured in terms of our effort or a stable currency.
Correct. That's just the natural outcome of progress and productivity.
But that's not what we experience day to day, is it? Prices generally go up.
Right. Which brings us to the idea of money as a measuring system.
Okay.
A good measuring system should accurately reflect reality, shouldn't it? If things get bigger, the measurement says bigger. If they get more valuable, it measures more valuable.
And if stuff gets easier and cheaper to make.
It should measure cheaper to make.
So the big question one source bluntly asks is, why the hell is a measurement system suck so bad?
Yeah.
What's disconnected? Why doesn't our money reflect this increasing efficiency?
It's a fantastic question. And the can of Coke example really drives it home.
Tell us about that.
So you ask anyone, is it easier or harder to manufacture and distribute a can of Coke today compared to, say, 50 years ago?
Obviously easier. Automation, logistics, materials, science. Everything's improved.
Right. A lot easier, most would say. And yet,
And yet,
it's maybe 20 times as expensive in dollar terms.
20 times for something that's easier to make.
Mind-boggling, isn't it, when you actually stop and think about it?
And the usual explanation is just, oh, inflation, or people are just greedy and they're charging more.
Exactly. Those sort of superficial first-order effects, as the source calls them. We don't often dig deeper into the why. Why is the measuring stick itself seemingly broken?
Yeah. Why doesn't our increased productivity translate into increased purchasing power across the board
And that's where Bitcoin circles back in, conceptually,
as the cheat code?
as the potential cheat code for life, yeah. By offering a way to save in money nobody can print, money that might better reflect actual value or scarcity over time.
A way to opt out of that broken measuring system.
That's the idea. Spend less than you earn, save in sound money. A path back to building wealth through prudence, not just speculation forced by a depreciating currency.
It's a compelling framework. And this difficulty in grasping these fundamental shifts even affects the experts, right? Let's talk about Kenneth Rogoff.
Ah, yes, Professor Rogoff.
a very, really famous economist, known for his work on government debt, right? That whole idea about debt to GDP levels going above 120% being a danger zone.
That's him, a big name in macroeconomics, though he did walk back some of the more radical conclusions from that specific paper later on.
Right. But still, highly respected. And back in 2016, he wrote about Bitcoin.
He did. And it was pretty slamming Bitcoin,
Yeah.
as our source puts it.
What did he predict?
His take was stark. He said it was either going to be worth $100,000 or $100.
Okay, quite a range.
But then he added he thought it was probably more likely to be worthless.
Ouch. Dismissive, to say the least.
Very.
So fast forward, Bitcoin did hit that $100,000 mark he mentioned as the high end.
It did indeed, against his expectations.
And apparently he recently acknowledged this, but it's being called the worst apology ever.
Huh. Yes, the description is quite pointed.
Why? What did he say? How did he explain being wrong?
Well, his reasoning was interesting. He basically attributed his error to two main things. First, he said he didn't realize the government wasn't going to shut it down.
Okay, fair enough. That was a concern for many.
And second, he pointed to unforeseen events, like, quote, "We have this crazy president who's buying billions of dollars worth of Bitcoin," referring to El Salvador, presumably.
Ah, so external factors he couldn't predict.
That was his explanation. But the critique in our sources is quite sharp.
How so?
It highlights the irony. The source poses this rhetorical question.
Eh.
How could I have known that the soundest money that has ever been created by humans would be in demand?
That's pointed, implying he missed the fundamental value proposition itself.
Exactly. That maybe the reason it succeeded wasn't just because governments didn't ban it or one leader bought some, but because it actually offered something intrinsically valuable that people wanted. Sound money properties.
It's a fascinating example, isn't it? How even brilliant people can struggle to update their frameworks when something truly new comes along.
It really is. It shows how hard it can be to break from established models, especially when dealing with something that challenges the very nature of money and value.
And maybe how a new generation just perceives value differently, too.
That could be part of it, too.
Yeah.
It really makes you think about how we all process new information that clashes with our existing beliefs.
Definitely need to question assumptions, even from respected voices.
And just be open to the evidence as it unfolds.
Okay, so let's quickly recap this deep dive then. We started with the market noise, the dips.
And saw that maybe, through a log chart lens and compared to history, things are actually pretty chill.
Right, and influenced by institutions buying those dips now.
Then we looked at Bitcoin's underlying strength, not just in dollars, but against gold and commodities, breaking those long-term resistance levels.
Suggesting a more mature, robust market, perhaps.
And then we explored that big disconnect.
Yeah.
Why things get easier to make, but cost more of our money.
The broken measuring stick idea?
Yeah, and how Bitcoin is framed by some as a potential solution, a way to save in sound money.
Finally, we saw how even top experts like Rogoff struggled to grasp the shift, leading to that rather awkward apology.
Highlighting the challenge of adapting to genuinely new paradigms.
So the value for you listening is hopefully getting a handle on these deeper currents.
Yeah, seeing beyond the day-to-day price swings.
Whether you're new to all this or you've been watching it for years, understanding these dynamics, the institutional flows, the relative value, the measurement issues, it just helps you filter the signal from the noise, right?
Absolutely. Gives you context, helps manage your own perspective.
Which leads us to that final thought, something for you to maybe chew on.
Okay.
If our tools, our technology, our human effort, if it's all constantly improving, making things easier, more efficient to produce, what does it really mean for our future, for our kids' future, when the tool we use to measure all that value, our money, keeps telling us we're getting poorer, that our effort buys less?
It's a powerful question.
How might a sounder measuring stick, one that maybe holds its value better or even reflects that increasing efficiency, how might that change how we think about wealth, about work, about progress itself?
What does real progress look like if your money actually reflects it?
Exactly, something to ponder.